Dr. Alex Kamau is the guest whom we've had before. He's a business consultant and a university lecturer. He's our guest again today. Dr. Kamau, good morning.
Good morning to you, Eric.
Karibu sana to Kenya's biggest conversation.
Thank you very much for having me once again.
Very good. You're here because we want to talk about borrowing, and particularly focusing on domestic borrowing and what's been happening in the markets in the last couple of weeks, going back into months, maybe even into years. And then projecting what's likely to happen in the next financial year. With this high budget deficit, we are definitely going into domestic borrowing again. What do we expect to see? To welcome you to the conversation, CT has the day's proverb.
Our proverbs for the whole of this week, now the weekend's on Friday, our proverbs are from Kenya. This same one, not the other one, this one. No matter how tall your grandfather is, you have to do your own growing. That's a proverb. Grandfather tall, very good. You grow.
You grow.
You grow.
But
you grow.
It is your job.
Your grandfather has grown, we know, because he can't grow. In fact, if anything, he might shrink. But you...
Dr. Kamau, what do you think these Kenyans are trying to tell us?
No matter how tall your grandfather is, you yourself, you need to grow. Or you have to
your
grow.
Own growing.
Yes. I think that talks about that as a person, you don't have to depend on the credit or the ability of other people, even if they are your family members or your parents. You have your own journey to walk. You have your own space to occupy. You have your own legacy to live at the end of the day. And this most likely, I think it fits in areas where maybe a child has got a very strong financial background, and he's usually told that he shouldn't look up onto the wealth of the parents, but he should work very hard so that he creates his own wealth. That's my understanding.
Very good understanding. Higher. Let's talk about our borrowing. Okay. So we are at a position where we are looking at what we call a budget deficit in the current financial year that's ending in 9 days' time. When the National Assembly first passed the budget last year, there was a deficit of about 600. Was it 800?
Yeah, it was 830.
It was 830 billion shillings.
Billion shillings.
That means the National Assembly allowed the government to go and look for this money in the market. Borrow. Talk to World Bank, talk to China, talk to Dr. Kamau in the market. Whoever you get the money from, you borrow and you will repay. We are closing the year with a deficit that's shot up beyond $1 trillion. Which means we have borrowed more than what we had initially said we were going to borrow. A large proportion of this has been borrowed domestically. Now, what is domestic borrowing? How do we borrow domestically? Do they come to City and like, City, niko na kashida, kuna walimu hapa hivi wanakaa wanataka mshahara, kuna kakitu, niko na kachek, kuna kachek na ngojea ikiiva.
But meanwhile, we shikilia post-dated.
Is that how the government does it?
More or less the same, but they use a different tool that is called treasury bonds. Treasury bonds, we have treasury bonds and we have treasury bills. Treasury bonds is when the government borrows long term. That is, it issues a financial instrument whose maturity term is more than 12 months. It can be 2 years, 5 years, 10 years, 15, even to 25 years. When it wants to borrow short term, it uses treasury bills. Treasury bill is a financial instrument whose maturity term is less than 12 months. It could be three months, it could be 6 months, 9 months, and 12 months. So that's how the government borrows locally. Last year, the budget deficit was 830 billion. The government had proposed to borrow locally 500 billion and to borrow internationally 330 billion. But what you have just said, Eric, is that we have borrowed more than that in this year that is supposed to end in the next few days. The reason we have borrowed more than that is because of the same reason that we will borrow more this year compared to what the government said in its budget. Because the government, the budget that you have just read, it says that we will borrow about 720 billion Kenya shillings. But that is not very true, because there is another 850 billion that we will borrow. The 850 billion is the amount of loans that we will borrow to repay the principal loan that is falling due in the next financial year.
Sorry.
Yes.
We'll borrow Jack.
That last thing you've said, that
Yes.
the amount of what will do what?
What the government is saying it will borrow, the 720 billion shillings, is to repay the interest on the debts that we already have, the interest only. But now that has not factored in that we also need to reduce the amount of the principal debt that is existing.
Okay.
You see? It's not just me.
No, it's not just you.
Yes.
It's like there are two debts here.
Yes.
And the way Dr. Kamau is going, there are going to be 3 debts. In fact, we might even get to 10.
Yes.
Debts falling due means
Yes.
whatever we borrowed,
Yes.
are we still paying the interest, or are we supposed to pay the entire sum we borrowed?
It's a good question. When you are repaying the loan, you are supposed to pay the interest that is supposed to be paid
Which
within
accrues
that,
from it, yes?
That has accrued from that debt portfolio that you have.
Yes.
And also to repay a portion of that debt,
A
the
portion.
principal debt. Because if you keep paying the interest only, then you will never end or exhaust that debt, because you're only servicing the interest.
So what you're discussing, or
Yes.
what you're saying here,
Yes.
has to do with what is contained in the understanding we had, the contract we had, the documentation we had when we were borrowing.
Yes.
So it means we had agreed
Yes.
that over a period of time,
Yes.
we'll be paying interest at this rate.
For sure.
And then when it comes to this particular time,
Yes.
we'll now start paying the interest,
Yes.
but plus also
Yes.
beginning to pay off the principal sum.
That's true, but there are two types of loans. Like now, the Eurobond operates in the way you have just defined. That if we take like the Eurobond that we took in 2014 of $2 billion US dollars to do the SGR, it is a 10-year Eurobond that we will pay the principal amount of that $2 billion US dollars 10 years later. That is now next year, because we borrowed in 2014.
We'll pay all of it next year.
All of
We'll
it.
pay 2 billion
2 billion
on the 10th year.
on the 10th year. But every other year, heading to the 10th year, we'll be paying the interest on that Eurobond alone,
Okay.
which was about 7%.
That's what we agreed on.
That's what we agreed on.
Okay. Now, just so that I understand,
Yes.
we knew from day one when we borrowed we were going to pay this.
Yes.
Have we been putting money aside to pay for this, as we do everything that government does in terms of collecting money from us, taxing us?
Sasa pesa gani?
No, I'm just asking because we need to pay this
Yes.
thing, so we know
Yes.
on due date. Because from what we've been told,
Yes.
there are these things that exist in the treasury
Yes.
where it's not me or somebody coming. There's just a button which you press and the money goes where it's supposed to go. Okay? So that money has to exist.
Is
if
that
it's
the
supposed to go.
expectation, Dr. Kamau, that in the 10 years,
Yes.
you as a government will then be, putting some money in a reserve account in anticipation that you will raise 2 billion shillings to pay principal?
Yes, that is the preferred and the best practice in terms of financial management. That you should be putting aside a certain amount of money in anticipation that in the 10th year, it will not come to you as a surprise that you are required to pay the 2 billion, but you will have put a sinking fund. Actually, the correct name is a sinking fund, so that you match the income and liability, you align the two. Actually, what you would do is that every year you put 10% of that 2 billion euro bond into a sinking fund that is also generating some sort of interest.
Yeah.
So every other year you put. And for instance, the first year that you put the 10%, you will invest and say, this 10% amount of money, I want it to have a maturity term of 10 years. So that you are trying to match this first investment you have done with the maturity of this 10-year euro bond. bond. The second year you save the 10%, you will say you want to invest for 8 years or 9 years, 7, like that.
So you reduce your liability. So at the end of those 10 years, you are cushioned against paying this huge amount because one, you've put the money you're supposed to pay aside, but at the same time, you've been earning interest.
Exactly.
So it sounds like we've been doing that then.
Not really.
Because you have just said that we are going to borrow 850 billion shillings towards this 200 billion shilling debt.
Yes.
That means we have some 1.2.
The 2 billion US dollars is actually translating to about 267 billion dollars Kenya shillings.
At the current exchange rate.
At the current exchange rate.
Wait a moment. So are you telling us that when we borrowed the money, the dollar was exchanging for definitely something less?
Exactly.
We didn't peg it to that exchange rate.
No, we shouldn't. Unless now we buy another product which is called a future. A future is a product that you would say, I'm expecting to exchange this currency with this other currency. But if the exchange rate, for instance, Kenya shillings versus the dollar today is 140 shillings for $1. And probably in the next 6 months, I want to exchange, to repay a certain loan using the foreign currency or the dollar currency for this matter. So because in 6 months, we are not so sure how the currency will have behaved in terms of exchange rate, probably by that time it will be exchanging 200 shillings, Kenya shillings, for $1. So today we might agree. Today it is at 140. In the next 6 months we are not so sure. Can we fix it at 170? But there is a commission for that you pay for pegging and locking the exchange rate, because either way, if it is at 200, the exchange rate is at 200 shillings per $1 at that time, you will benefit, but this other person will lose. So for him to take that risk, you also need to put a consideration on the table.
The underlying assumption here is that you're hoping the exchange rate will favor you.
Yes.
So that at some point, for instance, the exchange rate between the dollar and the shilling, you will find that it was at 120, and probably now after a few years it's at 100, isn't it?
Yes.
Really? Yeah. And how often does that happen?
Sometimes it goes the other way around. And that's why, like KQ and the farms that usually rely on like now KQ, the way it imports fuel, it would need to come up with the pricing of its flights in a way that it is stable and it is assured that it will be profitable. So for it cannot rely on the way the fuel prices are very volatile. So they would say we are going to fix a certain price for the fuel, and more so in terms of exchange rates, that since we are buying fuel in terms of dollars, we want to say for the next 12 months, we'll be exchanging a dollar at this rate of Kenya shillings.
Now, Dr. Kamau, there's something that's happened in the market recently that has raised your flags.
Yes.
What is this?
What has raised my flag, a red flag actually, is that last week the government issued an infrastructure treasury bond. That is, and it gave at a coupon rate of 16%. And actually, the difference between an infrastructure treasury bond and an ordinary treasury bond is that an infrastructural treasury bond is income. The income that you generate after investing with the government through infrastructural treasury bond, that income is tax exempt. It is tax exempt. These other bonds, after you invest with the government and you are given your income in form of interest income, you have to pay tax on it. But the infrastructural treasury bond, it is tax free. And now there is something that we have been taught since primary school, that the government is a risk-free investor. That if you invest with the government, you are very safe. So, and that understanding always forms the basis for any person to make an informed decision when you are investing. So if I am to lend and do some money, I would say, if the government is giving me 16%, then to lend someone else, either a person or an entity, who I consider a riskier borrower, then I should add more a premium to the interest that I anticipate to get.
So essentially charge a higher interest.
to another so the government rate,
if the government the government is like the
baseline.
If the government is giving, if the bank is giving this risk-free entity called government at 16%, all of us others have risks, so it'll be definitely higher.
Exactly.
There's no way they can come and lend me 15%.
Yes.
And they know everything that I'm not like government. Okay. So that's one issue.
Yes.
16%. Why is 16% a big issue for you?
16% is a big issue for me because of two things. Number one is currently the banks, if you save the money with the bank, they will give you a maximum of 4% as interest for saving with the bank. But now here, the government is giving you 16%. And this 4% that the bank will give you after saving with them, it will still be subject to taxation. This other 16% is not. So actually, the banks will struggle to attract savings from citizens, because the citizens are rational investors. They will prefer to invest their money where it has a better rate of return. So in that sense, the banks will have a problem because the business of the bank is to attract savings and then to lend that money to the private sector. So if people are not saving with the banks, then the banks will have no money to lend to the private sector. So there's a problem there. And that is what we would say crowding out the private sector. So that's one way. And for instance,
people are likely not to take their money to the bank, but to lend the money to the government. Basically, you want to put money in an interest-earning account. Call it whatever. Fixed deposit, savings, blah, 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 whatever product banks have. Instead of going there, which is giving you 4-5%, you will take up the bond, which will give you a 16% return. Okay. What are the current coupon rates for the other bonds that they have? The ordinary bonds.
The ordinary bonds, over time, the coupon rate has been increasing. Because there's and if I can finish that issue of the bank, but the bank suffer also a big risk, and that's why a month ago the three main banks in Kenya, their credit ratings were revised downwards by JP Morgan credit rating agency from a B2 status to a B3 status. The reason they were downgraded.
Big commercial banks. Okay.
I would. It is in public domain, but I may not name the three banks. But it is in the public domains.
Don't worry, we live here, so we know.
The credit ratings was revised downwards. The reason for that is because they have been found to have invested heavily on treasury bonds.
Yes, they have.
And out of the 9.6 trillion that the government has borrowed, both internally and externally, 50% of that debt is local. That is about 50% of 9.6 is about 4.8 trillion. 50% of that 4.8 trillion is the financial institutions that have invested with the government. So the banks, the other financial institutions, they have invested to a tune of 50% of 4.8 trillion, to a tune of 2.4 trillion. So whenever the value of these investments, bonds, depreciate, then the banks also suffer losses. What we refer as a paper loss.
Okay.
Because the valuation of these assets will go down is because these banks invested with the government treasury bonds. Probably when these bonds, that time they were promised a rate of return of 10%. And they agreed with the government that I will hold on this bond for the next 10 years.
It's a fixed rate of 10%.
It is a fixed rate.
Because it's shilling to shilling.
Shillings to shilling.
Okay.
Yes. They agreed with the government that I'm going to buy this treasury bond and you'll give me a 10% rate of return for the next 10 years. That's okay. Then all of a sudden, 2 years later, the government has issued another bond that has a better rate of return at 16%. So every other person who had purchased that other bond, which is giving a rate of 10%, you would want to offload that investment so that you buy another investment which is more rewarding. So because every other person would want to offload, then there is oversupply of that bond. And when there is oversupply of any commodity in the market, then the prices and the value goes down. So that's what has happened. That what has made the JP Morgan Credit Rating Agency to downgrade the status of these three banks.
I still don't understand.
Yes.
Why are they downgrading the status of the banks? Simply because they borrowed from government, or because the value of the paper that they acquired has now reduced in value?
Exactly. It's because the value of your assets have reduced in value. And the way the banks are valued is your asset base vis-a-vis the money that is out there that you have borrowed out to, that you have lent out to. You have lent out to your borrowers. So if your asset base, if the value of your asset base decreases vis-a-vis the amount of money that you have lent out, then there is a problem.
So let me just understand this.
Yes.
The government has borrowed whatever it has borrowed.
Yes.
50% of it is from external
financiers.
Yes. And 50% from
is local.
Now, what is the preferred situation that would benefit the citizenry and the government at the same time?
Yes.
Would it be more beneficial if the government borrowed predominantly from the domestic market?
It is a yes and no. Because I would say, like, the reason that Japan actually was able to attain those high rate of growth.
That's where I was going.
Yes, is because the rich Japanese were able to lend the government, and whenever the government would pay those loans, that money would not get out of that country. It is within the economy. And now they would continue pumping that money into the manufacturing sector, into the service sector, and the economy would continue to grow. But
the uniqueness of the Japanese model is that there is also heavy government involvement in industry and commerce.
Yes.
But anyway, go on.
So, but in our case here is the debt market and the capital market is not very well developed. So like. If I go back to where I was saying that this year we are saying we will borrow 720 billion, but there is another 850 billion that we are supposed to borrow, and it's because the reason that it did not feature in the treasure in the budget is because I'm saying that I owe you 850 billion, but and I'm supposed to repay you in the course of next year.
Sure,
but I will tell you to roll over that debt I have with you. So basically, it will have no value in the balance sheet.
In the balance sheet,
because I will not. I will still remain to be indebted to you by 850 billion. Ideally, I should have removed that money from my pocket and give it to you. In that case, I will have reduced my debt. But in this case, I've told you, I will continue paying you interest. So because of that item is called an off-balance sheet transaction or item. It doesn't. So, but in the real terms, we will be borrowing 850 plus 720 billion.
Let's take a break. That's why our budget is 4.42 trillion.
Yes.
4.4?
4.45.
4.45.
Yes.
The
trillion.
Actual budget.
The actual budget.
So this 3.8 is just
window dressing.
Hiya! It's 26 minutes to 10. Kenya's biggest conversation is hosting Dr. Alex Kamau. He's a business consultant and he's also a university lecturer. We are talking about domestic borrowing and the red flags that Dr. Kamau is raising this morning. The government has gone to the market with an infrastructure treasury bond with a coupon rate of 16%. What's the impact of that? Not only on government borrowing, but also on private sector borrowing. and the entire financial sector. In the last week, in the market, the government went to the market with an infrastructure treasury bond.
Yes.
And they are quoting it at 16%.
Yes.
And that is going to have a ripple effect on very many other sectors and very many other things.
Yes.
The first thing that you said is the effect it will have on the previous bonds that had a lower rate
of return.
And people were holding that bond, all scrambling to try and get into this new one, and therefore trying to sell off what they have, which means that they flood the market with that cheaper bond, which gets even cheaper.
Yes.
Okay, that is number one. Number two effect?
Number two effect, if you look to something like the real estate sector, the rate of return there is about 5%. You take an example, someone who has an apartment in Kilimani, Kileleshwa, Lavington, Westlands. That apartment is worth about 10 million. And this person is getting a rental income per month of about 50,000. That is 50,000 multiplied by 12 in a year. It's about 600,000. If you less what we call service charge, maintenance fee, and maybe sometime the apartment might be vacant, that 600,000 can reduce to 500,000.
Yes.
So 500,000 divided by 10 million multiplied by 100 in terms of now we are looking for the rate of return per year, it is 5%. So
it actually reduces by more because that particular area is now saturated with many high-rise flats.
That's for sure.
So the would-be rent pursuer has more options than they know what to do with.
That's for sure. That's for sure.
And so, and then with the dwindling economy, the likelihood of people who even live there staying there is also dwindling.
For sure.
So if you own a block of flats, the likelihood of occupancy even being at 50 is a tall order.
Is a tall order.
Yes. So that percentage you say is a kind percentage.
Is a kind and a generous one. So, if you compare that rate of return for the real estate investments, which have been actually the darling of many investors in Kenya. So real estate is giving you a return of 5%, the government is giving you 16%.
Surely.
Would you go to the real estate?
Government.
Straight up.
I wouldn't even have to think twice.
So we are likely to see a stagnation in the real estate sector, and it has been one of the economic drivers of this country because it falls under the sector of manufacturing. So there's a challenge. Now we come to the issue of shares. Because as we have seen, the NSE on the wing of shares, it has been struggling. Many companies actually, when they declared their financial and their annual financial reporting a few months ago, actually in April, most of them they either reported reduced profitability compared to other years or even suffered losses. So the value of shares have continued to go down. And right now, the market capitation of the NSE shareholding is about 1.5 trillion. In 2021, January, it was 2.7 trillion. So the market capitation of NSE has shed value of more than 1 trillion. So what now that means is that when government is giving a better rate of return through treasury bond, you would want also to sell your shares and buy the government bond, which is again is tax-free. So we will see many people struggling to offload and to offload their investment in shares. And right now, the NSE is struggling because we have experienced foreign investors' flight because they have realized that the currency in Kenya is quite unstable, and they prefer to invest in developed countries like now the US, and especially now the US that has continued to increase the interest rates that they are giving on their treasury bonds. So NSE is likely also to suffer in a big way. So
there's capital flight from Kenya because people are now going to that other, which is bigger, better, more beautiful girl called the US that is lending at a higher rate.
Yes.
So we are not even attracting more money here.
We are not attracting.
And
it's strange because I would have assumed that if the exchange rate between, say, the Kenyan shilling and the dollar or the euro dipped in favor of these harder currencies, that an investor would find it cheaper to invest here simply because the exchange rate would favor them. But the opposite seems to be happening.
It is the opposite. You know what is happening is the Kenyan currency losing value vis-a-vis the dollar. And if the foreign investor had come here in Kenya and was promised a rate of return of 10%, for instance, you come and invest in yes.
I've got it.
You have got it.
I've got it.
Yes.
I've got it. So essentially,
yes,
you'll be losing money.
You will be losing money.
Yes.
You have been promised 10%, but the currency has lost value by 20%. So in the real sense, you are on the negative. You have gained 10, you have lost 20.
Okay. I want to understand.
Yes.
If we're essentially saying a situation has been created where in the domestic market,
yes,
there's surplus funds. Yes, there's money to be borrowed.
Yes.
By government.
Yes.
Why wouldn't they do that?
The problem with that is when the government is actually increasing the interest rates so that to convince the locals to do business with the government. For the longest, actually something like the treasury bills, they have the rate of return for treasury bills, the one that we said it's a financial instrument whose maturity term is less than a year. The rate of return for treasury bills has been 7%, 8%. Because again, we are still comparing with the banks. The fixed, if you save with the bank, if you open a fixed bank account, they will give you a maximum of 4%. So the treasury bills have been for the longest 7 to 8%, but now in the recent past, in the last few months, all of them, even if you are investing with the government for 3 months, for 6 months, for 9 months, all of them, the interest rate is above 10%. We say double-digit figures, and there's something. There's a liquidity preference of money. That when you are lending short term, you should demand a lower rate of interest. But when you are lending long term, you demand a higher rate of interest. But now, every other person, majority of the local investors, they are avoiding investing with the government long term. And whenever the government issues treasury bonds and treasury bills are usually oversubscribed. But people are avoiding treasury bonds because it means you will lock your investment for a long time with the government. So every person wants to invest, most majority, to invest with the government for 3 months. After 3 months, the government will give back your money. Yeah. So in case there are some other changes, shocks, you are out. So the government now, to convince Kenyans to invest with them long term, now they have decided to entice them more by increasing the rate of return.
What does that mean? Does it mean, because do I detect desperation here on the part of the government? Because not only are they competing with the banks, they are doing much, much better than the banks, and they're doing much, much better than everybody else in the financial market.
Yes.
Is this a good thing?
It is not a good thing, because the banks, actually the government is kicking the can down the road. That these interest rates that we are promising investors, in the next few years to come, the debt servicing cost for the government will skyrocket. But as we are concerned about the here and now, but a few years down the line, now that's when the crisis will catch up.
This is about sustainability.
Yes.
When you borrow at 16%, and you're borrowing for development, and how long is this infrastructure bond?
It is 7 years.
It's a 7-year bond.
Yes.
What is it that they are going to do in 7 years that will earn this kind of money back?
Actually,
you know that you can say that you invested in dams, all right? Now the ripple effect of having this dam here is the agricultural activity downstream that has developed the economy. That 16%, you have to at least it makes 16% in 7 years. How plausible is this?
It is almost impossible, because right now we are feeling pressure, because the last government actually borrowed the $2 billion in 2014 through Eurobond
for SGR
for 10 years. And ideally they should have pushed for that years, so that since this is a developmental investment, capital expenditure, we should have bargained for more time So that by the time when we bargain for more time, it means we are paying a lesser amount of money per year, but we pay for a longer period of time. So that one would have been more sustainable. So what the government probably would now needs to do is actually also to move away from commercial loans and increase the appetite for concessional loans. And these concessional loans are the ones that are issued by multilateral organizations, like now the IMF and the World Bank. And we try to avoid commercial loans like now the Eurobond.
Dr. at that point in time, in 2014,
yes,
exchange rate was 85, 86.
87 there.
You're talking about some 50 plus. It's a colossal sum.
It is. And now what we are planning to do is to roll over. Instead of paying that $2 billion US dollars, we issue another Eurobond, so that since we have not been saving that money,
so it looks as
we
though
kick the can down the road.
Right. So it looks as though we'll forever be in this situation. It's just going to continue rotating. Whatever is left, carry it forward, borrow some more, carry it forward, have a good conversation, so that somebody says, "All right, we'll look at that." A new administration comes into place. You keep rolling. What is the danger of that when you're looking at it from a nation's economic outlook? What's the danger of that? Because we seem to have the blinkers on. Well, we seem rather not to have the blinkers on, saying there's caution here. The blinkers are not on.
That's for sure. The danger in that, the worst that would happen is us going the Sri Lanka way, where we default on the sovereign debt, and because of that, the inflation increases. Like now, the inflation in Ghana is at 42%.
Yes.
And here in Kenya, the inflation is at 8%, and we are feeling the heat. So we can imagine how it is like there in Ghana. And something else that the government is doing, which is not having the intended results, is the government has been increasing the lending rate, the BESO lending rate, the CBR rate. It is now at 9.5%. Last year, at a time like this, it was 7.5%. Wow. And the government increased in an effort to tame inflation. So right now, the CBR rate at Ghana is 29%. CBR, the BESO lending rate in Ghana, it is at 29%. And nevertheless, it has not been able to tame the skyrocketing inflation there, because inflation there is at 42%. So the government sometimes gets it wrong when they say every other time there is inflation, the first remedy or cure is to raise the CBR, the BESO lending rate. Because right now, and whenever the BESO lending rate is increased, what that means is that you and me, it becomes difficult to borrow money from the bank, because banks the borrowing cost,
CBR plus 4.
Plus 4.
So in Ghana, you're borrowing at 34%.
At 4%. Actually, Eric, now we have moved away from that capping.
From that capping.
Now the banks are doing risk-based lending.
In other words, whatever they like.
It's free fall.
Yes.
It's a free fall. If they think you are not good enough, they give you at 19%.
If they think you are dicey, 30.
Yes.
If you don't want, leave it.
Yes.
Hey, God Almighty.
Who makes the decision?
Yes.
On this rate, for example, when the government went to the market last week,
yes,
who in government made the decision to float it at 16%?
It's a good question. Actually, how two things. Number one is that that rate is informed by the prevailing bond yield of the existing bonds. The prevailing bond yield. Right now, the bond yield for the treasury bonds that have been previously issued by the government is at around 16.75%. 16.75%. And the bond yield is what we said that if you were to buy a bond in the secondary market, because when you buy from the government, that is the primary market. But if you are to buy from the secondary market, that bond that was someone had purchased at 100,000, right now he cannot be able to sell at 100,000. Probably he will sell at 70,000. But the person who has purchased this bond, the new owner, will continue to get the rate of interest return as the initial owner, which was so basically, if you have borrowed at 70, if you have invested 70,000, but you are still continue to get a rate of return 10% of the 100,000, so that is 10,000 over 70,000. So the rate of return now, that is what is called yield. So there's a difference between yield and coupon rate. Coupon rate is the original interest rate that the government issues at the primary auction. But when someone is buying in the secondary market, now that changes.
So the base indicator when the government is going to the market is the yield.
Is the yield
of the previous, the current bonds.
Of the yes.
All right. And that is what is currently at 16.5.
Yes.
So that informed them to come at 16%.
Yes.
Do they need to go to Parliament to seek approval to borrow, to raise this infrastructure bond, or did this approval come with the passage of the budget and the appropriations?
Last year the government had purposed to borrow domestically 887 billion. By end of April, they had only managed to borrow 497 billion.
You make it sound like it's a competition. Only managed to.
Yes,
they tried their best.
Yes. They have been. We have been experiencing investors' apathy, whereby the government issues treasury bonds, but the rate of subscription is about 25%. If the government had intended to receive about 50 billion. It ends up receiving about 15 billion. So because of that, the government has been behind schedule. And that's why when it got that opportunity last week, because actually this bond, they had intended to collect 60 billion. But to their surprise, people oversubscribed. And people are willing to give the government to a tune of 220 billion because the incentive was very enticing. But at the end of the day, the government was able to take 213 billion. So there are two things that are coming into play. One is the issue of the interest rate is very high. And number two, the government changed the story midway. Because initially it intended to borrow 60 billion, but because now people are willing to lend to the government more, they took more.
Dr. Kamau, always a pleasure having you. Thank you very much for joining us today.
Thank you very much.
Looking forward to the next one.
Wonderful.
And thank you very much for tuning into the Situation Room today and all the comments that we see on social media. Keep them flowing. Let the conversations continue.
This is the Situation Room, the only way to start your day.